Understanding how your lender is going to interpret your student loans may make a difference of at least $100,000 of purchasing power when you go buy a house. That's the topic of today's video. Thanks for showing up my channel. It's Anthony Fletcher, a lender's point of view. We're going to cover on conventional side and also on government side, and let's just jump right into it. First of all, on conventional side, you have the two major companies out there, Freddie Mac and Fannie Mae. They govern basically all mortgages out there on the conventional mortgage side of type of loans out there. And most people get those type of loans. Now, when we look at this, Freddie Mac, one company, what they use is they use a formula. When a lender goes out and actually pulls your credit report, it's actually going to show what the balance of each of your student loans are. And then some of them will show the payment, but some of them won't. So the lender's got to come out there and come up with some idea of how to put a payment in there so they can calculate your debt to income ratio. So the requirements of Freddie Mac is if there is a payment listed, they're going to use whatever the payment is listed on the credit report. But if there is no payment, they're going to use a formula of 1/2 of 1%. So that means on $100,000 worth of student loans, they're going to use a payment of $500. That's the way it was with at Wells Fargo. Wells Fargo sent most of their mortgages, conventional loans, to Freddie Mac. And that's the way things are done there. Now, I also worked for Chase Bank. And at Chase, for example, at them, they sent most of their mortgages to Fannie Mae. Their formula is different. They'll once again use the payment that's on the credit report, but if there isn't a payment listed on the credit report, then what they would use is a 1% payment. So that would mean instead of on $100,000 being $500 a payment, their payment would be $1,000. So when it really comes down to a mortgage rate of 5%, that's $100,000 that potentially you may not qualify for because they send their loan through Fannie Mae. There's other things that can also happen too. Now, if your loan is in forbearance or deferment, they're going to go back to whatever this calculation is if there is nothing listed on there. And usually what happens is that down the road, you promise to start payments again, but since the payments haven't begun yet, they're going to use this formula. Now, also, there's one other thing that Fannie Mae allows, which they don't do in Freddie Mac, which is a really neat thing, especially for those people out there that have already been working and established a job. Now, there's something that's called income-driven payment plan. And what the income-driven payment plan is simply this. You're going to go to your student loan companies once you've got a job, and you're going to go say, hey, this is how much money I'm making. I would like to see if I can get a reduction. And what will happen is they'll review your information. They might say, we'll reduce your payment to a lower amount for a full year, and then next year you need to reapply each and every year. If they'll produce a letter and actually send that to you, and you can actually give that to your lender, and then they can use that payment. So a great example is this. Is that a client that was going to get a Fannie Mae mortgage, and so their payment was going to be $1,000, but they went and got this income-driven payment plan program, and it was a $54,000 student loan they had, and their payment ended up being $123. So it really helped them qualify for a lot more. So I could put them into a Fannie Mae program versus using Freddie Mac. So it's really important for you that your lender actually can handle both Freddie Mac and Fannie Mae type of programs. Okay, now what happens, for example, if you're in collections? Well, generally what happens in the collections is the lender is going to go, they're going to send it to their underwriter, and the underwriter probably is going to require you to go back and set up a payment plan, but that is not 100%. If the underwriter is able to get an approval from using the computer decision engine, then they may be able to go ahead and go forward. It all kind of just depends, or they might just manually put in one of these numbers in there and go forward with that. So it's a little bit different when you get to the actual government side. So we're going to be talking about FHA, USDA, and VA type of loans here. Now they all use, once again, the payment that's listed on the credit report, or if there's no payment there, they're going to use 1/2 of 1% of the balance. So that's going to be the $100,000. If you have $100,000 on your student loan, they're going to use a $500 payment. Now, if it's in forbearance or if it's in deferment, they're going to use this 1/2 of 1% still. Now, the big difference here when it comes to government loans is that if you're in collections on a government student loan, you can forget about getting a mortgage going government unless you get reestablish a payment system. So you won't get a loan going this way if you've got a government student loan that is in collections. So you've got to get this fixed. And once you get this fixed, the lender may decide, based off of who it's going to be sent to, might decide to either have you show 3 months of payments, 6 months of payments. They might even want to see a full year's worth of payments before they actually will give you the mortgage. So that way it reestablishes that you're making payments. So what's to cover all this, let's kind of go back over the key points that you should know about this. And one is things that you need to do is you need to make your payments. Once you get your student loans out there, you really should make the effort to go out there, make contact with your student loan company and get the payments set up and get them on automatic payment. Don't wait for the bill to come each month and make the payment that way. Just set it up on automatic payment. Next, keep good records. Get copies of all your notes that you got for your student loans. The lender might require those. And if you have those, it can actually benefit you from time to time. By having them, it might show a lower payment than what is actually showing on the credit report or by using this formula. Next, be proactive. And what I'm saying about this is don't wait around. Go out and get that information. Get all that together for your lender at the time of application. The sooner you get it and the better the package that your lender can send into the underwriter, the more eligibility as far as how quick your loan's going to be approved, and also make it much easier for you when it comes to gathering other documents needed. Finally, work with a lender that's available that can do both conventional and all the other government type of loans out there, because if they can do that, they can get you probably the best deal out there and qualify you for the most amount of mortgage. If you only go to one company that maybe only specializes, say, in Fannie Mae loans, you may be stuck with this type of payment and more difficult underwriting requirements. So if you go to maybe like a broker, they'll have options with many different lenders, and some may have certain benefits and some have other benefits, but they'll find the right one for you. Well, that covers it for today. Thanks for coming to my channel. If you do like this video, please hit the subscription button and also the like button. If you do have comments, please let me know. I'd be more than happy to respond to them. And thank you very much, Lou, for your request on doing this video. Have a great day, and we'll see you again